Imagine this, you inherit $1 million. A fantastic start, right? But let's be honest, many people who suddenly find themselves with significant wealth don't hold on to it for long. Fortunes vanish, investments collapse, and dreams quickly turn to dust. Why is that? It's not simply bad luck, it's often a fundamental misunderstanding of how money truly works. The core issue isn't about smart investing, it's about managing risk, specifically, the margin between what you have and what you're willing to lose. Let's explore this. A 10% return on a $1 million portfolio sounds impressive, doesn't it? $100,000 gained. But now imagine a minus 10% loss. That's minus $1 million gone. The scale of potential gains and losses is dramatically different than most people realize. Think about Lehman Brothers, once considered too big to fail. Their aggressive use of leverage, their margin debt, amplified the impact of the 2008 financial crisis. It wasn't just a market downturn, it was a catastrophic loss of capital. All fueled by a failure to manage risk relative to their overall position. This isn't about judging past decisions. It's about understanding the mechanics that can lead to devastating outcomes. The reality is, even seemingly smart investments can be wiped out if you're not meticulously tracking your exposure and your ability to absorb losses. It boils down to this: wealth preservation starts with recognizing the power of a single percentage point, positive or negative, multiplied across a substantial sum. Let's strip away the jargon and get to the absolute foundation. What's the fundamental logic behind preserving capital? It's not about chasing exponential growth, it's about maintaining your purchasing power over time. Think of it like this: a dollar today is worth less than a dollar in 10 years, due to inflation. Your goal isn't necessarily to double your money every year, that's incredibly difficult and inherently risky. Instead, the primary objective is to ensure that the wealth you have today can still buy you what you need and want tomorrow. This leads us to dynamic allocation. Wealth doesn't just sit there, it moves through different assets based on their risk/return profiles. How much potential they offer versus how volatile they are, and the prevailing economic environment. During a recession, for example, investors often shift from stocks, which tend to fall in value during downturns, to bonds, which generally hold up better. This is about adapting to changing conditions. But there's another crucial element: information asymmetry. Rich individuals actively manage this gap between their knowledge and the rest of the market. They don't rely on public opinion. They employ specialized advisors, analysts, and research teams to sift through the noise and identify opportunities before those opportunities become widely known. Imagine trying to predict a stock's movement when everyone else is already acting on that prediction. You're immediately at a disadvantage. Let's illustrate this with a simple example. Let's say you have $10,000. If you invested aggressively in a high-growth tech stock and it skyrockets. Fantastic. But what happens when the market crashes? You could lose a significant portion of your investment. Conversely, if you invested that same money conservatively, perhaps in a diversified portfolio of bonds, you'd still have something to show for it during the downturn. The consistent application of even modest returns, compounded over decades, demonstrates its power. Consider this: $1,000 invested at 7% annually for 20 years will grow to over $8,653, significantly more than a portfolio that experiences dramatic swings due to aggressive growth strategies in volatile markets. It's about consistency and understanding the long game. Now let's put this into action, simulating a $10 million portfolio over 20 years. This isn't about predicting the future, it's about demonstrating how a disciplined approach can navigate market fluctuations. We'll use a conservative allocation, 40% in stocks, acknowledging their potential for high growth but also their inherent volatility. 30% in bonds, providing stability and income, 20% in real estate, offering a lower sensitivity investment option. And 10% in cash, acting as a buffer against uncertainty. This is our margin, the portion of our capital we're willing to risk. Now, let's run this simulation under different scenarios. First, a mild recession, stocks decline by 15%, bonds hold steady. Real estate sees a slight dip, around 5%, and cash provides stability. Second, a severe recession, stocks plummet by 40%. Bonds experience a more significant drop, 20%, real estate declines further, 10%, and cash cushions the blow. Notice how the portfolio's value fluctuates based on these conditions. Crucially, throughout both scenarios, we consistently rebalance down in equities during downturns, bringing the allocation back to our 40/30/20/10 target. This isn't about reacting emotionally, it's about maintaining our margin and protecting capital. We're not aiming for massive gains, we're aiming for survival. Let's track returns across these scenarios. In the mild recession, we might see a total return of around 5%. In the severe recession, despite significant losses, we could still end up with roughly 10%, a remarkable outcome considering the circumstances. The key takeaway isn't about winning. It's about consistent execution and disciplined rebalancing. This simple simulation demonstrates that even modest returns consistently applied over decades can dramatically outperform aggressive growth strategies in volatile markets. It's not magic, it's mathematics. But here's the critical trade-off: maintaining this low margin, prioritizing capital preservation, limits your potential upside gains. If you only invest in very safe assets, you'll never experience those moonshot returns that some investors crave. And there's a psychological trap to be aware of: when markets are rising, it's incredibly tempting to chase hot investments, increasing your risk and potentially leading to devastating losses. Think about the dot-com bubble. Many investors piled into internet stocks at inflated prices, only to see their fortunes evaporate when the bubble burst. The trade-off is always between security and growth. Constant vigilance and disciplined allocation are required. Let's illustrate this with a graph. Imagine two portfolios, one that aggressively pursued high-growth stocks during market booms, let's call it the aggressive portfolio, and another that followed our conservative strategy, the conservative portfolio. During periods of strong growth, the aggressive portfolio would undoubtedly outperform. However, when the market inevitably corrects, and it always does, the aggressive portfolio will suffer far greater losses than the conservative portfolio. The conservative portfolio might experience a smaller decline, but its overall returns over 20 years would likely be significantly higher, because it weathered the storms. This isn't about being boring, it's about recognizing that risk and reward are inextricably linked. The greatest investment you can make isn't in a stock or bond, but in your understanding of the forces driving capital flow, and the discipline to manage them. So, what's the single most important shift you need to make? Stop thinking about winning investments. That mindset is inherently flawed. Instead, focus on understanding capital allocation as a system, a continuous process of managing risk, diversifying across asset classes, and actively seeking information advantage. It's not about predicting the market, it's about controlling your response to it. Wealth preservation isn't passive, it's an active, ongoing management task. It requires constant learning, adaptation, and a willingness to accept losses, because losses are inevitable. Remember, our simulated portfolio didn't aim for explosive growth. It aimed for stability and long-term value creation. The greatest investment you can make isn't in a stock or bond, but in your understanding of the forces driving capital flow, and the discipline to manage them. Don't chase fleeting trends, build a resilient foundation. That's how rich people keep their money moving, not through luck, but through intelligent, disciplined management.